Now, if you are freaking out about the market right now, stay with me, because I have a lot to tell you. So here's what I want you to understand. There's no more important time than right now for you not to make moves that are going to hurt you. You see, the stock market has crashed 14 times in the last 100 years, and it is showing all the same signals. Inflation rising, debt increasing, trade wars, increasing tariffs, global tension, political chaos. The same signals as 1929 Great Depression, 2000 dot-com crash, 2008 global financial crisis, or the 2020 global pandemic. And the crazy thing is, there are so many people who are completely unprepared and have no idea what to do when this market crash happens. However, there are some people who will be so excited and know exactly how to take advantage of it. And that will be you by the end of this video. Now, I have went deep into exactly how the smartest of investors use crashes not just to survive, but to really grow their money and accelerate their wealth. In this video, I'm going to be sharing the 5 eye-opening lessons that I've discovered from studying over 100 years of financial crashes, so you don't have to. Now, this is going to be the biggest opportunity of your life, so be sure to stick around until the end. Part 1, the key patterns. You see, if you study crashes, you'll realize they are like watching the same movie on repeat. You know the setup, you know the mistakes, and you know the moment it all begins to fall apart. Other people will be caught off guard, but you will know exactly how it is going to pan out. In the year 2000, investors were blindly putting money into companies that had no revenue, no profits, just an idea and a fancy name ending in .com. It was all hype, no substance. Fast forward to 2008 when banks were giving out home loans to people who couldn't afford them. Then came 2020. The world literally came to a halt. Lockdowns, job losses, travel bans, the economy froze overnight. Different events, different triggers. But the emotional reaction, always the same. Fear, panic, denial, followed eventually by opportunity. Let's rewind even further. To the 1930s. During the Great Depression, the US government raised tariffs on foreign goods to protect American industries. But that backfired. Other countries retaliated with their own tariffs. Global trade collapsed. So did businesses, and that led to one of the worst economic periods in history. Now, why is this relevant? Because today we're seeing similar warning signs, rising interest rates, ballooning national debt, ongoing trade wars, and yet most people are not connecting the dots. But the smart investors, the ones with experience, they see it coming because they know market crashes are not random. They follow patterns. If you learn those patterns, instead of reacting emotionally, you can prepare. You can even grow your wealth significantly when others are losing theirs. Now, before we move to how billionaire investors really think, here's a quick primer on some terms that'll be helpful later. A market correction is when the market drops by about 10%. It's common, happens every year or two, and it's not necessarily a bad thing. A bear market is a deeper decline, usually a 20% or more drop from recent highs. This can last months or even years. And a market crash, that's a fast, severe drop, often over 30% in a matter of days or weeks. That's when fear peaks. Understanding these stages helps you stay calm, because you'll know where we are in the cycle and what might come next. Part 2, how smart investors think differently. When most people panic, smart investors act. Why? Because they've trained themselves to stay calm when everyone else is losing their minds. Let me give you a real example. In 2008, while the news was full of stories of job losses and bankruptcies, Warren Buffett was busy buying shares in companies he believed in. At bargain prices, he wasn't guessing. He had a plan. Buffett's famous quote is, "Be fearful when others are greedy, and greedy when others are fearful." What does that mean? When everyone is optimistic and pushing prices up, he becomes cautious. But when everyone is panicking and selling, he steps in to buy. That mindset, doing the opposite of the crowd, is a huge reason he built a fortune worth billions. And it wasn't just him. In 2008 and again in 2020, plenty of investors who bought during the crash ended up doubling or even tripling their money during the recovery. Why? Here's the secret. Crashes create millionaires. Contrary to popular belief, market crashes do not destroy wealth because crashes don't destroy wealth. They transfer it from the unprepared to the prepared. So here's the real question. Which side do you want to be on? Part 3, why most people still lose money. Now maybe you're thinking, all right, I get it. Don't panic. Buy when the market drops. But if it's really that simple, why do so many people still fail? Let me explain. Have you ever made an emotional decision even though logically you knew it was the wrong one? Like eating junk food on a diet or texting your ex late at night? That's what happens during a market crash. When the market drops, your logical brain, the one that knows about long-term investing, gets hijacked by your survival brain. That monkey brain doesn't care about long-term returns. It just wants to avoid pain and fear. So it tells you, sell everything. And that's why people lock in losses. Not because they don't know what to do, but because they let emotions take over. So here's the lesson. Emotional control is just as important as financial knowledge. Part 4, the 3-step plan smart investors use. So what do experienced investors actually do when the market crashes? They follow a clear, simple plan. Step 1, keep cash ready, but not just for emergencies. They keep some money aside specifically to invest during crashes. They know corrections and crashes are part of the game. So when the market drops, they don't panic, they see it as a shopping spree. Step 2, use dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of whether the market is up or down. Over time, this smooths out the impact of market volatility. So instead of trying to buy at the exact bottom, which almost nobody can do, they buy consistently. And when prices fall, they end up buying more shares for the same money. Step 3, diversify your investments. Smart investors don't bet everything on one stock or sector. They spread their investments across different industries, different asset classes, like stocks, bonds, gold, and real estate. This protects their portfolio when one part of the market underperforms. And most importantly, they stick to the plan, even when it feels scary, especially when it feels scary. That's what separates them from the average investor. Part 5, how to recognize the signals. Okay, here's a question I get all the time. How do I know when the market has bottomed out? Truth is, you never know for sure. But there are some signals that smart investors watch for. 1, the VIX index, aka the fear index. When the VIX spikes above 30, it means investors are scared. Above 40, that's full-blown panic, and historically those levels have often signaled that the market is near a bottom. 2, investor sentiment surveys. These measure how bullish or bearish investors feel. When everyone is negative, that's often a good contrarian signal. 3, insider buying. When CEOs and executives start buying their own company shares, it's usually because they believe the company is undervalued and about to rise again. When all 3 of these signals show up together, it's like a giant flashing neon sign that says buying opportunity. Part 6, every crash ends. Every single time. Here's what you have to remember. Every crash eventually ends. The 1929 Great Depression, the market eventually recovered and created a new generation of wealthy families. 2008, after the crash, we had the longest bull market in history. 2020, within a year, the market not only recovered, it hit all-time highs. The point is, the market always bounces back. So instead of asking, will there be another crash? The real question is, will you be ready for it? Because if you are, it can be the biggest wealth-building opportunity of your life. Most people don't fail because they don't have knowledge. They fail because they don't have a plan. Or worse, they have a plan, but they abandon it the moment fear sets in. So here's what I want you to do next. Make sure you have a strategy that works in good times and bad. Because remember, market crashes are not the end. They are the beginning of something powerful. While you are researching your own style of investing, make sure to check out this video here. This will help you tremendously by trimming out some things that people say are investments but are actually the opposite. They are money drain. More important than knowing what to invest your hard-earned money is to know where not to put your money in.